if he's right, he still has a legacy, a high level of dissent that you haven't seen since the early 90s. Two people dissenting, him holding rates high. And if he's wrong, he's totally screwed because everyone knew he's too late Powell. The question is, will he stay belligerent Powell and trying to kind of get back at the president?
Well, you were right last year in calling for a cut before inflation reaches 2%. So we're nowhere close to 2% still. In fact, it's gone up. What's then your outlook for the rest of the year? How many cuts are we getting? Thomas Hayes, managing member of Great Hill Capital, returns once more to the show. We'll be talking about his outlook for stock markets and his reaction to the latest news regarding the jobs revisions on Friday, as well as the new tariffs imposed last week. Welcome back to the show, Thomas. Good to see you.
Thanks for having me, David. Great to be here.
Initially, I wasn't really sure what the markets were reacting to last Friday afternoon. Was it the jobs revisions? Was it tariffs? Was it both? What do you think?
I think that certainly the jobs, largest overall revision in 50 years. I mean, that's not just a government rounding error. It's not even in the same ballpark. So what that did was it took us from a hawkish setup following the Fed meeting last week when everyone was like you couldn't believe how belligerent Powell was being regarding rate cuts when you consider the level of how restrictive he is right now. And then you get this jobs report on Friday when it acknowledges, oh my goodness, the labor market is a lot weaker than anticipated. So their dual mandate is back on the table, which is very constructive. And we're seeing already the odds of a September cut have moved up over 90%. So that is going to change a lot of things. And you started to see it even reflected yesterday with all the indices down except for one. What was the one? Small caps were up meaningfully yesterday, which will be a huge beneficiary of rate cuts because they've got slightly more leverage and operating leverage in them. And the cuts imply we could see a reacceleration now that they finally get off the boil and move.
Well, here is also, I'm going to get back to the your market outlook in just a minute, but this is the news that I want to get your reaction to. Trump firing of labor statistics chief undermines credibility, ex-leaders say. So the BLS chief, Erica McAntifer, was fired over what Trump claims was rigged or so-called faked employment numbers in the run-up to the 2024 election to boost Kamala Harris's chances, said this article. Like you said, biggest revision since 2013, 73,000 jobs added. Here's, I want to get your reaction first, and then I want to show you Ray Dalio's reaction on Twitter. He claims that he would have fired her too, but not for the same reasons. But what is your general assessment of whether or not BLS data is useful as an investor or investment and or trading indicator?
Yeah, I would say two things. One, biggest revision, 2-month revision since 2013, multi-month revisions going back 50 years. So whether there was a political motivation or not a political motivation, I have no idea. That's speculation. But, if you're building a house and, you're 4 feet off from where the baseboard should go, you've got a structural problem for years. So she's just simply incompetent. She wasn't bringing in the right technology or the right people to narrow that margin of safety to get accurate data. So just simple incompetence was a good enough reason to fire her and move on and get someone credible in there that's going to take action to reform and update and upgrade the data collection and dissemination. So I think that's number one. The second part of your question?
Let's take a look at what Dalio said here. I probably would have fired the head of the BLS too. That's because his process for making estimates is obviously error-prone and obsolete. There is no good plan in the works for fixing it. Well, if it's error-prone and obsolete, why are we using it as any sort of trading indicator at all?
Well, one, I don't use it. I think this is in the scheme of short-term voting machine, long-term weighing machine. Like these revisions eventually get it right. So if you're using it on a month-to-month or a week-to-week basis, which we don't do, then yes, this data is really not helpful and potentially harmful to your outlook. if you're an investor and you're looking at the free cash flow of a company and the revenue growth and the moat, it's completely meaningless because you will have, after a few months, the correct numbers. I think what Dalio is saying, based on that article that you just posted, is exactly what I'm saying. Something is wrong. Regardless of the motivation, you need someone to upgrade the systems and improve the data collection and dissemination. And if there was any issue, political bias, et cetera, that's another reason. But that can't be proven at the moment, and it's irrelevant. The key is the output is insufficient and not acceptable.
Well, the bigger picture then on the jobs numbers, do the job numbers indicate any significant meaningful slowdown in employment activity, thereby potentially lowering margins and weakening earnings for this quarter or next?
Yeah, look, I think, if you look at the revisions going back multi-months, that was a period of significant uncertainty. So it might be the lagged effect, because what you've seen since then is C-suite confidence after Liberation Day was kind of resolved. The market started to recover. You're seeing CEO confidence come back. As a matter of fact, last week was the biggest week in years for deal activity, M&A, et cetera. The investment bankers in the Hamptons aren't playing golf. They're busy on the phones in August, which is pretty unusual. So animal spirits have come back. And I think that it might be more of a rear view looking mirror phenomenon, but it's also a message to the Fed like, hey, you really are too restrictive and you really are too late, because once the unemployment starts to tick up, it's very, very hard to put that genie back in the bottle. Inflation, on the other hand, you can quell pretty quickly. So in other words, when you think about risk reward in terms of a dual mandate, let's assume this trend persists and the weakening job market persists, and it wasn't solely attributable to Liberation Day and the uncertainty around Liberation Day. Well, then you're probably already too late with cuts. However, if it is a short-term phenomenon, and let's say you cut too early and all of a sudden employment starts roaring back with CEO confidence and C-suite confidence, and inflation ticks up because you cut too quickly, well, it's very easy to quell inflation. You could simply do a hike of 25 or 50 basis points and put inflation back in the jar. You can't do a cut, 25 basis point cut and put unemployment back in the jar. It just continues to persist, and fear builds upon fear builds upon fear. And then you wind up having to go with, if it's a serious recession, a $500 billion, multi-$100 billion stimulus to get the economy back on track. And that worsens the deficit. So there is no real downside for being, quote unquote, too early with cuts. And by now they're way too late with the level of restriction they've had, 200 basis points for, half a plus year. So if there's no downside to cut too soon, hypothetically, and there's massive downside to stay restrictive and be too late Powell, well, you have to take that into account. And now where you have the one governor resigning, you have dissent on the Fed, for a guy that's so concerned about his legacy, now he's kind of boxed, because if he's right, he still has a legacy, a high level of dissent that you haven't seen since the early 90s. Two people dissenting, him holding rates high. And if he's wrong, he's totally screwed, because everyone knew he's too late Powell. So he's in a box now. He's got his out with this latest jobs report, and he can use this to save face and pivot at Jackson Hole. The question is, will he stay belligerent Powell and trying to kind of get back at the president? But that doesn't help the world. It doesn't help the country, and it certainly doesn't help those people that are in the labor market, for sure.
Before we continue with the video, let me tell you about a very serious threat that you're facing every day that you may not even be aware of. Most people have no idea how much of their personal information is floating around on the internet. Your address, phone number, and email can be found and sold by data brokers without you even knowing. That's why I use today's sponsor, Delete Me. It scans data broker sites for your personal information and removes it. And it doesn't stop there. It keeps checking and clearing new listings throughout the year. Once you sign up, you'll get a privacy report within a week showing you exactly where your data was found and what's been taken down. It's a straightforward way to protect your privacy without having to chase every site yourself. Go to joindeleteme.com/DavidLin and use promo code DavidLin at checkout, or scan the QR code on screen right here to get 20% off all US plans. Take control of your personal data before somebody else does.
Well, you were right last year in calling for a cut before inflation reaches 2%, so we're nowhere close to 2% still. In fact, it's gone up. What's then your outlook for the rest of the year? How many cuts are we getting?
I think we've got to go at least 2, and I think that's all we're going to get. We should probably do 75 to 100 basis points. That's kind of neutral, and that gives you enough cushion in case Powell's prophecy of inflation being more than a one-off comes out to be true. I think that's the right level. You know, if you look at housing being 16% of GDP, he's really put that in a box, and that's hurting a tremendous amount of the population. You know, our largest portion of the population is the millennials, and the average age of home buying has gone from first-time home buying has gone from 28 to now 38. That's put their whole lives on hold. That's kind of reduced the incentive to have children. If you can't afford a house, why are you going to have kids? And a lot of that generation, because of Powell, have now resigned themselves to not having children, not having the joy of family formation, not having the joy of a starter home, not having an ownership stake. So there are a lot of unintended consequences created by a guy who's interested in how he's written and not being Arthur Burns, which the current economic state has no resemblance to the conditions that Arthur Burns faced in the 70s, demographically, economically, or otherwise. It's a shame. If you had said to me, David, 6 years ago, would you rather have a successful business person running the Fed or an academic? I would have said business person, hands down. I was wrong. Give me the PhDs out the wazoo that actually understand the economy, or at least understand how to manage a central bank. I think Powell would have been an incredible Treasury Secretary. I think he's a genuinely good, competent person. I don't think he has the skill set for the job.
Moving on from the Fed, do you think markets, generally speaking, are more receptive to Fed policy now or fiscal policy, and especially trade certainty? In other words, what are the biggest triggers going forward for the rest of the year?
I think the tariff policy is a headwind. I think the one big beautiful bill is a tailwind that's not yet priced in. So the short-term negative effects of the tariff policy are being offset by the one big beautiful bill, which is not fully priced in. So I think it's a net positive all in. And therefore, I do think the economy reaccelerates. And what we found also, going up 50% on India and 250% on pharmaceuticals and all this other stuff. What we know about this administration is they will bend things but not break them. They will bend them as far as they can get. But if the bond market and the stock market starts to look like it's breaking, like we saw in early April, they quickly show flexibility and rationality, and they reverse those positions. So they want to get as much as they can without breaking things. And I think the intent of the administration, and rightfully so, is for the economy to do as well as possible. And candidly, President Trump does measure his success by what the Dow does, and he's not going to let it go that far down, because it's not helpful to people's retirements, it's not helpful to confidence, it's not helpful to animal spirits, and he wants to see it grow. And what we're seeing with real wages now coming back to levels not seen since his first term is Main Street is doing tremendously better than they did prior to him coming in the last 4 years, as Main Street real wages are re-accelerating again and people on Main Street are doing better.
Your overall thesis for the rest of the year, in notes that you sent me, you reiterated your long stance, and you wrote that dips are to be bought. Sit on your hands and do nothing, you said. Can you elaborate?
Yeah, we're in the seasonally weak part of the year, August, September, October, everyone knows. So everyone's looking for a big correction. And I think what they're going to be disappointed with, certainly those looking for big corrections, 10 or 20% are going to be sorely disappointed, because on average, you get a 20% bear market correction every 3.5 years. We've had 3 in the last 5 years. So we've pulled forward 10.5 years of bear market corrections. I do think that 3 to 5 to 8% corrections are possible after a 30-something% move off the lows. But what you have to keep in mind is there was record selling in the whole. $1 trillion of equities were sold the day before Liberation Day, predominantly hedge funds, institutional managers. You know who got it right was the retail investors, and they've gotten it right. Every single dip since COVID, they've been buyers, not sellers. Institutions and hedge funds have been wrong, and now they're all dramatically behind their benchmark. So they can't buy the things that are already up. They have to buy the laggards in an effort, and they got to do it with leverage, in an effort to catch up to their benchmark and keep their jobs, which is why you have seen in the last 7-8 weeks one of the biggest pockets of outperformance, 11% more than the S&P 500, has been the most shorted stocks, the most hated stocks. Those laggards that have been the last to move have now started to outperform. And I think that's going to be the theme. So if we see some volatility in the indices, basically now, if you talk about the S&P 500, you're just talking about Mag 7. And what did we see with Mag 7 earnings, the 6 or so that have reported, is they were good, okay? But they're decelerating. So last year, 33%. This quarter, 14% earnings growth. By Q3 next quarter, what no one's really talking about, it's going to be the first time that that earnings growth of the Mag 7 is 10% or slightly below 10% earnings growth. So why does that matter? It matters because the multiples relative to the earnings growth have not come down. If you look at the Microsoft's 10% earnings growth, 33 times multiple, the Amazon's 31 times multiple, 8.5%. Are they great businesses? You bet. Are you paying up a little more than you should based on the earnings growth, and certainly in a decelerating earnings growth environment? Yes. Contrast that with something like the small cap indices, which will dramatically benefit from the reinitiation of Fed cuts more than anyone else because they've got the most leverage. And if you look at earnings growth for 2026, small Russell 2000 expected earnings growth is 37%. That's excluding the benefit in terms of their debt servicing when rates start to come down 50, 75 basis points, versus the S&P 500 at 14% earnings growth. And furthermore, you're getting a much lower multiple still on small caps with more than double the earnings growth than you are on the S&P 500. So managers will have no choice but to start to buy those, start to buy the unmagnificent 493. So if you're saying, oh, do I buy the S&P 500 index right now, which is basically saying, oh, do I buy Mag 7 right now? I think you're going to be disappointed. You're probably going to be net up. So if we get, 3, 5, 8, 7, 8% volatility in the next few months, maybe you do, maybe you don't. I think there's so many people off sides. I think the surprise would be that we actually push higher and don't get any material correction, which would be the maximum pain trade right now, because people are not positioned for that. More people are lightening up or behind the benchmark than are overweight and giddy right now. If you look at all the sentiment indicators, some are a little bit elevated, but they're not really giddy, which kind of implies to me the pain trade going into the fall, with everyone looking at seasonal weaknesses. Maybe we get more strength than expected, but certainly in the places that no one's focused on would be my bet.
I wonder if they're more expensive because they're the best in class businesses. And so if you're paying a bit of a premium on valuations, it's because you're buying better businesses, which would, in theory, outperform the small caps longer term. What do you think?
I think with recency bias in the rearview mirror, the last decade, that is correct. Mm-hmm. If you go back the last any period longer, small cap value is the highest performer. So, and that goes for value generally speaking. The data got skewed in a period of 15 years of ZIRP. So unless you're betting on ZIRP coming back, that's probably not your highest and best use. And if you go back 100 years and you think about, do I allocate 100% of my money to value or 100% of my money to growth? Well, if you put $1 million in value versus growth in 1928, value, you would have $68 million more today because it outperforms on average about 4%, not in aggregate, 4% per year compounded over 100 years. Where people are sideways is like they were in the late 90s, which is that growth has outperformed the last, 10 years in this case. Therefore, it's going to outperform forever. And I think what people miss is a great example is Amazon. When you look at the Palantirs and different great companies of the world, Amazon was one of the greatest companies in 1999 and 2000. And we were all betting that what they said was going to happen in the future would happen in the future, which would be, it would be the store of everything. They would deliver everything to your house. It would all be online, etc. And guess what? They did everything they said they were going to do over the next 15 years. The problem is, in 1999 and 2000, you were paying for them already having delivered that 15 years of value at that time, 15 years early. So what happened over the next 3 years? Amazon stock was down 90% from 2000 to 2002, 2003. And it wasn't down 90% from 2002 to 2002, 2003 because we were in a recession, okay? Because the fundamentals of Amazon's business in each of those years, 2000, 2001, 2002, 2003, continued to improve. Revenues continue to improve, cash flow continued to improve, earnings continue to improve. The price of the stock went down 90%. Why would that happen? It happened because Amazon was a great company. Amazon is a great company. The problem was the short-term voting machine, the emotional voting machine, was 15 years too early. You were paying for 15 years of performance 15 years too early, and therefore the stock price had to correct to where the fundamentals actually were, not to where they would be. And then by the time as we got closer to 15 years out and all the things they said they were going to do in 2000 were actually happening, the price caught back up. And I think we're seeing that with a number of these super high flying stocks right now that are doing unbelievable things and will be doing even better things 5, 10, 15 years out. The question is, are you already paying for it? And will you have a reckoning in the intermediate term when the market says, yeah, they're great, but you've already paid for the next 20 years of seamless, perfect execution. So if they come in 1% lower than the perfect execution, you're not going to get a 1% pullback. You're going to get an 80% pullback. And those are the type of stocks we want to avoid. And what we want to do is look for our turnaround Tom specials that are durable, predictable businesses that have been generating cash for decades and have predictable trend lines of cash flow and revenues that have a temporary dislocation because they're out of favor due to rates or due to sector dislocation, where the short-term voting machine price is not pricing in 15 years of greatness. It's pricing in that they're going out of business, and there's no way in hell they're going out of business. So therefore, when the mood shifts and the flavor of the month, the stock market, it's like the stock market's like Baskin Robbins. What's the flavor of the month? Right now, it's not those great companies that when that comes back into vogue and Rocky Road is back in flavor, you get doubles and triples in 24, 36 months. And that's what we like to do, rinse and repeat over and over, boring, durable businesses that furthermore, we can allocate massive amounts of capital. We can take 10% positions. You can't take a 10% position with a company that's trading at 100 times sales unless you're a cowboy and you're reckless, because at some point, maybe it'll double again. But you're gambling. You have no downside protection, because when the music stops on those names, it's not a 3% pullback. It's everyone rushes to the exit at the same time, because there's no fundamental underpinning for the current price, even if the businesses are fantastic.
Are there, in the universe of Tom's special stocks, are there any sectors or subsectors within the AI infrastructure trade that would fit the criteria of not being super overvalued right now? In other words, AI infrastructure, how would you play that besides just buying those AI stocks outright?
Yeah, I mean, look, that's not a core theme for us, because we think the actual key beneficiaries are going to be the companies that implement the AI, which are not yet priced in. The efficiencies and the margin improvement and the productivity and the margin expansion that's going to come to regular everyday business is not yet reflected. So if we're buying great businesses, they're going to become greater business with the advent of AI. But in terms of like simple exposure to the theme, we like energy. Okay, so one of the names that we have around $7-8 is Comstock Resources. Jerry Jones owns the majority of the stock, 70+% of the stock. We're co-investors with him somewhere around $8 a share. It went up to $30 a share. It's now at $17. We're in the market buying more. It's going to $50 over the next 2 to 3 years. So that's a no-brainer for us. Continual demand for energy. The other backdrop you need with all the data centers is generators. So Generac has been a huge hit for us. Started buying that thing below 100, shot up to 190, corrected. Now it's back knocking on the door of 200. That probably goes to 250, 300 plus. That's another energy play. I think the dark horse in all of this, I know there's a lot of noise around Intel and everyone's saying it's a bag of what, but the fact of the matter is, you heard it from Trump yesterday. They've got to produce chips in the U.S., and they're the only game in town. Yes, Taiwan Semiconductor has fabs and they can invest in that, but they want to invest in Intel. Intel and Lip Bhutan, that's going to be the dark horse surprise in the next 48 months. You can't give the stock away right now. If they liquidated it tomorrow, you get 100% of your money back. And if on their legacy business, it's worth $40, $45, $50. And if they actually get their production in gear, which now they've got a partner in the government going to have to stop them, and Lip Bhutan, who at Cadence Designs had like a 50+ bagger. This guy knows how to do turnarounds. He knows everyone in the industry. He's going to get it right. You wind up with $100 stock. And that's something that I can sleep like a baby at night, because I know what my downside is and my upside's unlimited if they get half of their projections right, versus buying something that's already priced for absolute perfection, and then if they miss by 1%, the stock's down 50%. So I'd rather buy it when it's already down that much and then get my doubles and triples, versus holding on with white knuckles and praying to God that the next earnings call they don't wrinkle their nose the wrong way and everyone runs for the exits.
Here's another piece of news that I'd like you to comment on. So the Trump brothers, Donald Trump's sons, are now backing manufacturing SPAC, filing for $300 million U.S. IPO. It's going to be called New America Acquisition Corp. New America said in the filing that it aims to buy businesses with a combined enterprise value of $700 million or more, and will target companies that play a meaningful role in revitalizing domestic manufacturing, expanding innovation ecosystems, and strengthening critical supply chains. Are those themes that you're also interested in as a manager?
Yes. Yeah, I think the reshoring is going to be a key theme. I think they're playing a lot of the thematic plays. They're obviously heavy in crypto. I was at the New York Stock Exchange. They were promoting some gun company. So, they've got their hands in a lot of pots. But I do think that theme of manufacturing resurgence in the U.S. is a durable theme. And some of these technologies, whether it's AI robotics, whether it's are going to help accelerate that, because what largely makes the U.S. uncompetitive is regulations and labor costs. So Trump is going to gut the regulations, and some of these technologies brought to you by robotics, brought to you by AI. I mean, we're seeing it in one holding we have, GXO Logistics, which Brad Jacobs was one of Brad Jacobs' spinoffs, one of the greatest wealth creators for stockholders in history, whether it was Waste Connections, United Rentals, XPO. Now he's got QXO and he has GXO. They're one of the biggest utilizers of these humanoid type of robots in their warehouses. Not the Tesla ones, but other companies make great robots. And they will continue to benefit. And that's a huge scaled business with one of the largest logistics providers in the world, and warehousing and et cetera, shipping, return. They handle returns for major companies. So I think you're going to see more and more of that. And as the GXOs of the world can implement more of this automation, their margins are going to go up and up and up, which is going to give them price competition and scale where they can just squeeze out all the competitors over time. So I want to be in those forward-thinking companies that are actually utilizing the technology versus the ones that are creating it and trying to guess who's the winner. I'd rather bet on sure, durable businesses that have a free option of massive margin expansion by utilizing the technologies versus gambling on who's going to get the technology right.
Okay. And then finally, you've previously mentioned that we're in the late stage bull cycle. Correct me if I'm wrong. What would shift your outlook into a bear phase?
I don't think we're late stage. I think we're mid phase.
Okay.
I don't think I ever said. Yeah, I don't think I ever said that. That's the other Tom Hayes. But
that's on the other specials list. Okay.
No. Listen, I think if you look through history and over the last 100 years, any country, any region, pretty much, when you have the bulk of your population in their mid 30s, that is the period when they do the most consumption, family formation, housing formation. It has been delayed by bad policies by Chair Powell, but it's pent up. And I think that's durable, and it tends to drive above trend growth and above trend spending, above trend consumption, at least until their early to mid 40s. So our base case is that we are in the second leg of a durable bull market that probably goes into the early 2030s. So any of these 3, 5, 8, I think our pullbacks this year are going to be contained to 3 to 8%, if any. And as we look out into the 2030s, 20% corrections are to be bought, not sold. And then I would say things could meaningfully start to slow, like we saw 2000 to 2015 as we get out to the early 2030s into the 2040s. I'd be a lot more cautious. But right now, if I can find out of favor stocks and sectors with a margin of safety, I'm buying all day long.
Finally, are you positioning for higher beta plays besides the small caps, which we talked about? Are you looking specifically for more higher beta, more volatile plays in this bull market, or are you mostly sticking to, betas closer to 1? Yeah.
Yeah, I don't think in those terms. I don't think in terms of Sharpe ratios. I don't think in terms of beta. I think that's noise created by consultants. What I do is I look at a business by business basis, and here is my filter. Okay, I will underwrite a business as if you were going to buy 3 Jersey Mike's franchises down the street. If I said to you, David, there's 3 franchises in aggregate. They generate $1 million after tax per year. Okay. And then I said, and they do call it $3 million a year of revenue in aggregate. And I said, I want $400 million for them because there's a growth opportunity. Would you write that check? And the answer is you'd be like, you're out of your mind. Or here's even better, David. How about if I said they do 3 million of sales, they're losing a little bit of money, but you're such a smart guy, I know you can manage it better. How about 250 million? We'll just charge you, $100 100 or 80 times sales instead of 100 times sales. You say, get out of here. I'm not going to buy a business that's losing money and pay 100 times sales. That's absolutely crazy town. So what I try to do is I look at businesses that the prices come down a lot and they have a long history of performance, both on revenue, free cash flow, earnings, and they tend to have normal cycles every 10 to 8 to 10 years where the price pulls back quite a bit. And the price pulls back a lot more than the free cash flow temporary impairment, a lot more than the revenue temporary impairment. And sometimes there is no impairment in the underlying fundamentals. It's just the flavor of the week is strawberry. It's not Rocky Road. And I get to buy great businesses at 60, 70% off. And Turnaround Tom plays the game where I have my edge, which is called time arbitrage. I'm patient. I don't, if I buy a stock that's down, 60%, and it goes down 65%, I don't even think about it, because how I underwrote it, David, is very simple. If JP Morgan was going to finance me to buy 100% of the business myself, with the only caveat is I had to put up 100% of my net worth as the equity. Okay, so let's say it's a $200 million business, and they say, we'll give you $170 million of debt, but you have to put $30 million of cash up. And if the business does poorly, we get the business, your $30 million is wiped out. If the business does well, because of the leverage you have on it, that $30 million is going to be worth $300 million. I will do the deal. If I'm not willing to put up 100% of my net worth to buy the business, why would I even buy one share? And the difference between my framework and most people is they see Tesla's going up in the news, or whatever company is going up in the news, and their friend, bought a share and it went up, and they traded in their Honda for a C-Series Mercedes, and they've got to jump on the thing. And then they get holding the bag like 2001 with Amazon because they bought a great business at the wrong price. So we try to buy good businesses at a great price, and then we just trade out of them in 3, 4, 5 years when they've, usually 2 to 4x, because we bought them at great prices and their cash flows and revenues are very, very predictable. And that's where I got the nickname Turnaround Tom. We just rinse and repeat. We buy predictable businesses. We don't have to guess the future. We don't have to play the Bureau of Labor Statistics game on a month-to-month basis. We don't give a what about that stuff. What we care about is free cash flow going up? If it's not going up, why is it not going up? Is it a temporary impairment? Is it a permanent impairment? Have they handled it through other cycles? Is their moat still durable, or is it permanently impaired? And we look at that competitive advantage. And then the final filter is, would I put up 100% of my net worth? If I wouldn't put up 100% of my net worth, why would I buy one share for myself or for clients if I'm not willing to take that? So we underwrite 8 to 10 companies. It's kind of like private equity in the public markets would be the way to think about it. And we don't worry about the short-term noise on a day-to-day basis. And it's a very happy, easy way to live, low leverage. And we're not white-knuckling every earnings report. We could care less.
Well, to answer your own question, the rhetorical question as to whether or not, or why you would put, why you wouldn't buy a company if you wouldn't, put 100% of your own net worth. Well, what if, let's say I were to say to you, during a bull market, animal spirits are high, and so you could maybe put a small percentage of your net worth into basically gambling because that's what everybody else is doing. Is there some merit to that? Yeah.
So rule number 1, don't lose money. Rule number 2, don't forget rule number 1. Mm-hmm. The number 1 lesson I learned in this business at the first hedge fund I worked with, and my boss was a very wealthy and smart guy, and he said, never let them take you out on a stretcher. And what happens is it starts like, I'll just do a small percentage, and it goes up a lot. And they don't know why it went up, but it went up because, whatever happens. It's a meme stock. It's the flavor of the month. Strawberries, everyone wants strawberry this month. It goes up, and they mistake luck for skill. Mm-hmm. So why would you do a 1% bet that turned into 2% when you could do a 30% bet that turns into 60%? Yeah. So next time they try 30%, and you know what? They're even more brilliant, and it happens again. And 30% goes to 60%. They have no idea why. Why the hell would you bet 30% and double your money when you could bet 100% and double your money? And sure enough, they do it. And it goes from 100 to 200. Now they're just a genius. They're already looking at calling a lawyer. How are they going to start their own hedge fund? Because working at Walmart, why would I work at Walmart when I could double my money every time I buy a stock? And then what happens is they say, why would I buy 100% position when I could actually take margin and buy 200% position and double that, and it becomes 400 or 300 on my capital? And guess what? The ambulance comes. They take them out on a stretcher. They lose their dog. They lose their wife. They lose their house. It's like a country song in reverse. And no one ever hears from them again, except 10 years later, you see them on the street and they've got a police badge on. And it's like, oh, how you been? Oh, I decided to become a police officer. So, you see this stuff over and over. If you've been through enough cycles, it tastes good until you see the extra pounds on the scale. And then before you know it, you can't get rid of it. So, there have been very few people that play that gambling game that walk away from the casino with chips. But the people who are investing in building the casinos and have a durable business plan, they make money all day long. So be the casino, not the gambler.
Understood. Where can we learn more from you and I guess get your Tom specials?
Yeah. Well, we've got the number one podcast in the hedge fund category, which is a very narrow category. It's called Hedge Fund Tips with Tom Hayes. Huge following among institutional investors, hedge fund managers, ultra high net worth individuals. Check that out on YouTube or wherever you get your podcast. Hedgefundtips.com is our blog. And then there's information, obviously, Great Hill Capital is where we manage money for wealthy people. You can get information there and see whether you're qualified. So, and family offices. So that's what we do. And then on Twitter, at Hedge Fund Tips, and on TikTok, we got a great TikTok channel at Official Hedge Fund Tips. You'll get a lot of value there.
All right, we'll put the links down below, so make sure to follow Thomas there in Hedge Fund Tips. Welcome back to the show. Good to see you as always, Tom. We'll speak again soon.
Appreciate it very much. Thank you, David.
Thank you for watching. Don't forget to like and subscribe.